So thank you, Terry and Justine, for having us here this evening. We're really excited to be part of this night. So first and foremost, just to clear the air.
I couldn't do that. Could you do that? How can they do that? Who are those guys?
Great. So as I just mentioned, so we were founded 25 years ago by John Nicola in Vancouver. And we're very excited that we have now grown across Canada, and we are the leading and fastest growing private wealth management firm. We manage $6 billion of assets for our clients on behalf of about 1,200 families, client families. Our staff of 180 people across 4 locations includes financial advisors like Ron and myself, support like Tracy, and I should say very dedicated support, in addition to our team of portfolio managers. And that's something very unique with our organization, that our group of certified financial analysts, their primary responsibility is the management of our proprietary funds and limited partnerships. On top of that, we also have a team of real estate professionals who handle our acquisitions across North America, in addition to development and asset management. So again, that's something that's very different to kind of other traditional wealth managers. So before, in terms of the agenda, so what you're going to learn this evening is we do have a very interesting and unique client testimonial that we will share with you. There's a bit of a twist to that, so hopefully you pick up on that. We'll then go over a little bit more about our process in terms of who we are, our investment philosophy, our approach to planning, and how that is really the integral point and part of wealth management. Of course, we're going to get into the how we do it. So again, both planning and investment management. And then finally, at the end, we're going to go through an interactive session in terms of giving you a better idea of the client experience. So taking a look at our financial planning workbook. So without further ado, I'll have you listen to Arv's story.
My name is Arv Such, and I've been working as a dentist for 17 years. I met my wife in Toronto. She's a medical doctor. We worked 4 or 5 days a week in our practices, and with a busy family with the children, acting as a taxi service for the kids, we didn't have time to really look at what our money was doing. We were making money, but we needed someone to be able to trust, to make sure that it was growing, but also from a conservative point of view, because the least thing that we could afford was to lose money. In 2008, we were down a considerable amount in our portfolio. I started looking at where many of the wealthy and established dentists, who didn't seem all that fazed by 2008, were investing their money. Their advisor was Nicola Wealth Management.
So Arv's wife is a medical GP. He was a dentist. He was very much what we see a lot of when it comes to, dental and medical professionals. He really just needed somebody to kind of walk alongside him and know that we were taking care of his own financial picture.
Mark was thinking of it from our perspective, and it was our needs being addressed. You could sense he had a great support team behind him. They said what they were going to do, and they did it. And that's all we needed. We could go back to our careers, in a sense, and keep working. And so that simplified our lives considerably. I'd been a client here for many years, and I had a conversation with the president of the company, David Sung, and I said, David, there aren't many other products out there that are available to us as dentists and as doctors that I'm so strongly in favor of, and I'd love to represent your company, Nicola Wealth Management, to be able to get it out to the community that I'm a part of. I went through quite an interview process with Nicola Wealth Management, and through the end of it, David said, welcome aboard, Arv. It was very important for me to be able to get it across to dentists and healthcare specialists. Look, this is a company that you can come to and get secure with your financial future. I'm all about consistency and predictability and being true on the outside and the inside, so I've seen both sides of it, and that really shines through for me. I've discovered that the inner machinations of the company match with exactly what its outer image is.
It's a really powerful story. Some of you are my vintage might remember Victor Kiam. Anybody remember this commercial with Victor Kiam? Remington shavers. Remember he liked Remington's, he bought the whole company. And that's similar to Arv. Arv is a big proponent. Prior to becoming a dentist, Arv was a pharmacist and looking for a change and became a dentist. And when he came on board, it was a continued evolution. So Arv is actually working with Nicola, both as a client, but also as an advisor now. He's come on board as well. And so we do have a diversified team. We talked about the 180 staff that we have right across Canada. Part of what really inspires me when I came on board recently was that about 99% of the clients that we have are clients we've always had. Our retention rate is 99%. So when I looked at this coming in recently, myself coming on board, what was it that was attractive? And so one of the things that's really attractive is just like in this movie, Top Gun, it's important to have a navigator and a co-pilot. So two people working with every family, and that's important for continuity reasons. So Jessica and I will work together on our clients so that we have that continuity. We have the ability to bounce ideas off each other and make sure that we're not in a single track focus, but that we're working in a collaborative fashion. And they're complementary skill sets, like Justine had said. We have different skill sets, we have common skill sets, but at the same time, it's like your peers. If you have a study club, you're working with them in order to come up with better solutions. Typically, there are two dedicated individuals. In addition to Tracy, we'll have other support staff that help. We meet at least twice a year, face-to-face, if you'd like it. We are here in London, Ontario on a regular basis. Many of our clients, after meeting us for a few times and getting used to what we do, are quite happy to not come into the office. They're quite happy to do a video chat. So we might be speaking to a client who's on vacation in Florida. We're video chatting. We're sharing our desktop with them so that they can see what it is we do. And you'll see some of that tonight. We do have a high focus on technology, really important to us. And part of that is the private client web access that we have. So this is where you would go and you would see everything that related to your file, all your statements, your fiscal report. You could upload your wills, your trust documents, your corporate documents, your notice of assessments. They're all in a digital vault for you in one spot. And soon enough, we'll have a mobile app that's on the way as well. But what is it that we do?
What's it say?
Well, it says, I love it when a plan comes together.
So our focus is on planning. And what does planning mean? There's not one type of planning. So we'll look at your salary versus dividend. We'll look at your compensation structures. If you've got a holdco, you've got an opco, maybe you've got a real estate company as well. Those are things that we'll look at and work with your professional advisors on. We'll look at your IPP versus an RRSP. Should we look at that? For some people, some entrepreneurs, we might look at an RCA as well, especially if you're looking to retire into a lower income tax jurisdiction. We'll look at insurance and working with our partners at Zavitz Insurance on that. We'll look at the tax-efficient asset allocation of your portfolio. Big thing nowadays, prescribed rate loans. We'll continue to work on that with you. And wrapping it all up, will and estate planning. So for many of you, when you think about a financial plan, sometimes you might think of a treatment plan. And I'll get back to this very shortly, but what I would say is financial planning for us is really organizing everything. So when you look at this here, a lot of pieces of the puzzle. Our job really is to put them together into a beautiful masterpiece in order to put it all together and work efficiently for you. So how do we do that? It is integrated planning. You can see the wheel here. It's complex, but they're all integrated. It's meaningful. It's fluid. It's ever-changing. We have to have a starting point, though, and that starting point typically, for most of our clients, comes with a discussion around retirement income modeling. What is that going to look like for you? And it's unique and it's continuous. We'll look at then the investments, and we'll go into that a bit later. We'll go beyond the stocks and bonds model that typically most people will look at. So when we look at the components of a financial plan that we put together, our first step really is to gather the data. We're going to build this current picture of compiling your net worth. Jessica mentioned it earlier. We're going to go through an example showing you how our workbook works. But we're going to put a 1 or 2 page executive summary. In my previous role at CDSBI, leading the wealth management division, our planners were terrific at putting financial plans together, but they were 90 pages long. Not many clients want to read a 90-page document. What we do that's very unique, I think, in this marketplace at Nicola is we put together a 1 or 2 page executive summary so that they're actionable and realizable steps to get to that end result. We identify and discuss goals and objectives. That's important, the short term. And we look, of course, at the midterm, because you've got those midterm scenarios as well. So the workbook itself, what does that look like? A typical workbook would look like this. We would start with your registered assets, what you're non-registered, maybe there's some cash and equivalents. Maybe you've got some real estate, either your professional practices in, and of course any business assets or attendant liabilities that would be on there as well. We take all that and we have a total net worth, and that net worth can be displayed to you by asset allocation. So in one step, you can see where your assets are allocated. And this workbook will sit in your web portal. You can access it at any time you wish. You can look at the different projections. You can actually interact with that. So if we focus on retirement, we're going to carve out the real estate because most people are going to look at retirement savings, not including their house. You're going to look at the savings that you put together. What do we do with that? As a first step, we transpose that into your workbook. And you can see the $1 million went there. And what you see is we have different variables that we can put in. The current age of this individual might be 40. They want to retire at 65. We've assumed an age till 90. And we've assumed that the average tax rate is going to be about 22%. The residual portfolio that this person will leave will be about $5 million in today's dollars. That's because they want to have $220,000 after tax annually, again, in today's dollars. That's always in today's dollars. And it allows us to arrive what's called a real rate of return. A rate of return after inflation that you need in order to save this kind of money. So in combination with your savings and your rate of return to achieve your desired outcome or your retirement. So that was the first step. The second step then is, okay, we know what we have to achieve in terms of our target rate of return. We got to now allocate those assets. So typically, most of you have seen this at some point in your life. It might be a conservative investor, a moderate, or an aggressive investor, and you have some mix between stocks and bonds. And typically, they're publicly traded stocks, TSX, S&P, maybe some world stocks, and bonds. You buy some fixed income bonds or bond funds, mutual funds. The Nicola balance fund, if you will, or approach is a little bit different. We're going to go into this a little deeper later on, but we would have other types of investments in there as well, in addition to equities and others. So, a little bit of fun we're going to have today. So we're going to have a question here, and at the end of this question, we're going to have a prize. So this future annualized real rate of return has been predicted for a traditional portfolio of stocks and bonds. So there's pads of paper on your table. If you could write what you think the answer is. A hint, inflation has been around 2% since then. So remember, real rate of return is what do I think a portfolio is going to earn? Less inflation. So take a moment to write down an answer. Awesome. Okay. Perfect. We'll continue on. We'll get that answer out soon. This was an article that appeared in The Economist recently in 2015 by Elroy Dripson. It was 25 countries' projected expected returns in portfolios on a go-forward basis. And what they looked at was that going forward from 2015 on, they saw that there was going to be more and more difficulty squeezing out returns out of public markets. And in fact, as low as 2%. So, when you go back to the asset allocation model that many of us are traditional asset allocation model, many of us are familiar with, whether it's conservative, moderate, or aggressive, and you said, okay, had I been in one of these, how would I have done since 2000 after inflation? A conservative investor around 2.3, a moderate 2.1, and funny enough, the more risk you continue to take, you'd actually done worse, 1.8% annualized after inflation. So what can you do about that? There are diminishing returns. More evidence to that effect. There was a McKinsey Global Institute that talked about this. They looked at the last 30 glorious years, and they said from 85 to 2014, we'd seen what's not normal. We had gotten used to a run-ups in the markets that just were not normal, and we're going to actually see a reduction in that on a go-forward basis. And some of the most biggest asset managers in Canada would have concurred with that, the Caisse de Depot, of course. So what are the odds going forward on continued low returns? Case-Shiller puts together this annualized PE ratio. PE is price to earnings. So how much am I willing to pay? How many dollars am I willing to pay for every dollar of earnings? Cash flow. So think about buying a stock, it produces a dividend. Buying a fixed income product, it produces dividend. Buying real estate, all those things. And what it saw that the higher the PE, the lower the expected return. So in 2017, that PE somewhere around 29, which is on the far right of historical PEs. Here's what's happened over the last number of years. In 1929, 36, 96, 2000, 2008, and 2018 were the peaks. And in fact, the only other time we've been higher than 2018 was 2000. The 2008 crisis was far lower than where we were today. Now this chart that you're seeing was produced in September of last year, roughly, September, October. I updated it a couple weeks ago. This is what's happened since then in January. Price to earnings have come off. We have seen, as you know, market volatility, but look where it is still even compared to 2008 or some of the other spots we talked about like Black Tuesday, Black Monday. Price to earnings are still at all-time highs. So the answer for a traditional rate of return, how many of you said 4? Hands up. 4. How many people said 3? Anybody say 2? 2? Anybody say 2? There's our winner. The answer is, what is 2 to 2.5%? Net expected rate of return on a portfolio going forward after inflation is going to be between 2 to 2.5. So how do you survive on that? How do you grow your portfolio, your retirement savings? What do you do? So that's where the third step comes in. It comes down to asset allocation beyond traditional stocks, public stocks, and bonds. So what do you look? What we would ask you to ask yourself or ask your advisor is, what rate of return have you earned after fees for the last 1, 3, 5, and 10 years, and after inflation? Really important to ask that. How volatile is your portfolio? What income is being generated annually by your current portfolio? And that's really important. That cash flow that you've got sustaining you in retirement is important so that when volatility kicks in, you're not forced to sell off assets. Where are the assets located? Is your fixed income in your RSP or in your IPP rather than in your non-registered or corporate savings? And what tax rates are you paying on non-registered assets? Finally, what's the tax liability on the estate? Putting all these things together really involves planning and the portfolio. And working with your accountants and your professionals, we're going to look at income planning and tax planning. Is the compensation you've got currently the most effective one? And that workbook that we work through with you continues to evolve, because that financial plan that you put in place today is not going to be valid the moment you walk out the door. Situations will change. Circumstances will change. So as we're meeting regularly with you, we are updating this workbook. So it's important to look at that retirement planning. How much do you need and want? How much can you save? What rate of return do you need? Your construction of your portfolio is really critical on a go-forward basis. Do you own a diverse array of assets? Does it go beyond stocks and bonds? And again, the investment location and estate and will planning. So that integrated and fluid approach, that circular approach that we talked about earlier, continues. So you start at the top, you go through here, and then you go again. And it continues on a regular basis. So one of the things that people will ask me about, and one of the most common questions, is really it's all about the money. Right there, the reason the internet was created. That's it, cat videos, awesome cat videos. So the common question, the most common question we get as advisors, Jessica and I, is how much can I spend? And the answer I always say is it depends, right? Sort of like my teenage daughter saying, how late can I stay out? Well, it depends who you're going out with, where you're going, all those things. A lot of factors to look at. So this is an individual we might look at who's today 62, wants to retire tomorrow. They're going to live to 95. Their investment rate of return is forecasted there. They have an average tax rate in retirement and so forth. So let's focus on the assumptions here, and we'll go into some specific examples for you. I've got $3 million of investable assets because I sold the practice. I've got a 20% average tax rate on retirement. I'm assuming some CPP and 100% OAS received onwards from age 65, and returns somewhere between 2 and 5. Remember those low returns we talked about? So we're going to see the effects of returns on your retirement, how important that is after inflation and fees, and if we can, most of our clients want to preserve the capital after inflation. That's really important to them. So how much money can I spend? Well, if you make 2% on your portfolio, you've got about $72,000 a year. As you start to make a little bit more, you can see it becomes exponentially larger. So the difference between 2 and 5, which simple terms is 3%, in effect is more than double spendable income. The impact on returns is huge, and it's really not a small trivial thing. So if you can make 3% versus 4, very big difference on your portfolio and on your spending. And what that also means is if I'm spending $120,000 a year and I'm generating that on my portfolio is untouched, right? I don't have to sell my portfolio. Let's re-engineer this in a different way. How much capital do I need if I want to spend $180,000? So let's assume $180,000 after tax. And again, similar idea, I want to preserve the capital. How much money do I need in order to spend $180,000? Well, at 2% rate of return, I better have almost $10 million. But as I start to do better, net after fees, net after inflation, if I can make 5% net, I only need $4 million as opposed to $10 million. So what that means is a 3% increase in return means you need 60% less capital in order to sustain the lifestyle you want. So when we say that small differences, they can really add up, we want to focus on how can we add those small differences. How do you do that? Because we looked at low returns going forward through the traditional stock and bond model. We know that small differences are going to make a big impact. How do we do that? So the answer to that question really is in this question here. So ultra-high net worth investors and pension funds consistently have a higher weighting than retail investors in these two asset classes. Write down your answers. What is? Write down your answers. All right. So, how do we diversify beyond the traditional stock and bond model and add what we'll call less conventional assets? What does that mean, less conventional, Ron? Is that cryptocurrency? Is that Bitcoin? Is that weed stocks? What does less conventional mean? Well, let's not come up with the answer ourselves. The answer is already out there. Capgemini did a report in 2016, and they looked at the high net worth market around the world. And they said, what do high net worth investors invest in that traditional retail people do not, maybe cannot have access to? And what they found is that globally, many of them will only have about 27% in equities. Remember that pie chart I showed you earlier, 60-40, 50-50, maybe 70% in equities? On average, they're investing about 27% in public equities. They're investing about 13% in alternative, another 17% in real estate. Nearly 30% of their portfolio is in the non-traditional market. Tiger 21, anyone heard of Tiger 21? It's a special club. It's a multi-millionaires club. In order to be a part of Tiger 21, you must be a retired business owner. You must have at least $10 million plus of investable assets, and you want independent advice. So what they do, these are clubs around the world. They sit at a table like you are today, and they say, what are you investing in? What are you investing in? And they work with each other. And they looked at Tiger 21 members, and they said, what are they investing in that traditional people do not? Traditional people are not investing 50% of their money into real estate and private equity. So the rest is everything that you and I would traditionally have invested in. 50% of their portfolio is in real estate and private equity, because these are very different kinds of asset classes that traditional investors don't get into. Let's talk about that a little bit. So if we know that it's Tiger 21, it's not just high net worth investors. What are they trying to emulate? They're trying to emulate the Ontario Teachers' Pension Plan, which currently has nearly 40% of their investments in non-traditional assets and have had about a 10.2% rate of return since 1990. That's because they're one of the largest pension funds in the world. They diversify outside of traditional asset classes. It's not just in Canada. CalPERS out of California. Harvard, when you look at their endowment, they've got 200% more assets over 41 years. Why? Because their asset class ranges in the public markets somewhere between 16 to 44%, but in the private equity market and real estate, they always have a significant weighting. So the answer is, of course, what are private equity, debt, and real estate? When we talk about real estate, we're talking about commercial real estate. Anybody get that answer? Hand up if you got it. Okay, keep your hands up. We have a tiebreaker question. All right, and it's going to be the closest to it without going over. Is that right?
For this one, you're going to write it down as well. So we mentioned that we own commercial property across North America. So how many properties do we own? So if you could please write that down. Oh, so Nicola.
Nicola
Nicola
Wealth Management.
Yes.
On behalf of its clients.
That's true.
Owns how many properties across North America?
Okay.
Anybody say 100 or higher? One hand? Two hands? Two hands? What number?
130. 140.
The answer is?
163.
There we go. So, thank you so much. So when we look at our traditional, what we'll call balanced model, we showed you this pie chart earlier. It does have some, of course, diversity to it. It has real estate. It has private equity. It has private debt in it. Alternative strategies. Yes, it does have equities, public equities, but together it's only about 30% of the portfolio. Now, that's not enough. We further diversify within those sectors even more. So when you look at our portfolio, and this is as of September 30th, real estate isn't just one fund, it's comprised of a number of funds. Bonds, global bond fund, high yield bond fund, primary mortgages, balanced mortgages. What you're going to see here in our approach, and we're going to talk about this a bit later, is a high degree of cash flow. Because again, if we can get you good cash flow on your various assets, you're not going to have to eat in that portfolio if we can sustain that cash flow for you. And we're going to give you an example of that a bit later. So how do we add value beyond the public markets? Here's an example of a recent real estate acquisition that Nicola did. We acquired this building for $12.2 million. Focus was to roll the leases up a little bit better and bring it up to market risk. At the time, when we bought it, it was 100% full. There was a full occupancy. We were getting about $32 a square foot in San Francisco. The building was appraised at $12.5 million. Cap rate or cash flow rate was around 5%. Well, we did some upgrades. We rolled some of the leases and brought in better tenants. And what we were able to do, take you up to $70 a square foot, $20 million now the appraised value, and the cash flow is still around 4.8%. So what we got out of that, was about a 66% increase in value for the client portfolios. And this is what our clients are investing in. This is one property of how many? 163 properties across North America in different markets. So what else makes a difference? So if we've already discussed that for all of you and all of us, what's going to make a difference is diversifying beyond the traditional asset classes. What else makes a difference in our portfolios and your portfolios and everyone's portfolio is us as humans. We have investor behavior that sometimes works counterintuitive to what we would think we should do. So there was a book written by Michael Lewis called The Undoing Project. He also wrote The Blind Side and The Big Short as well. So building on that work, two economists, one Daniel Kahneman, who is polar opposite to his colleague, Amos Tversky. One is an introvert, the other one's an extrovert. Both are psychologists, one taught at Stanford, one at UBC, and they received the Nobel Prize for their work in economics. Really worked together in what we'll call a bromance to look at human behavior when it came to investing specifically. And what they uncovered is something called loss avoidance. So I think a nice way, an easy way to explain this is, on the right-hand side, I have $100. On the left, I've got $80. If I were to approach any one of you and I said, I'm going to give you a guaranteed win of $80, you're going to roll the dice, but you may lose 15% of the time to win that 100, mathematically, we should all be going here on the right. Mathematically, this irrational choice is on the right-hand side. I can make more money here than I can on the left side. But what do the majority of us do? We choose the guaranteed win. It's a lower payout, but I'm guaranteed. So what they found was, what if I said, I guarantee you're going to lose $80? The other alternative is, you may win 115% of the time. Mathematically, what should we be doing? Taking the guaranteed loss, because it's less, $80 versus over here. Most of us will choose that. We want to avoid the loss. And so that is what drives our behavior. And so when we talk about investor behavior, what are the 7 habits of highly ineffective behaviors? My favorite one is this one here, over-optimism. Show of hands, how many people here think they're in the top 50% of driving ability? Right? Okay. I think the other question sometimes we ask is, how many of us, top 50% are good-looking people? Right? We all have this over-optimism about us and our situation. Right? We're all in the gifted program. Not this guy. Right? That's not me. Right? So it's important that we think about the business that we're in. 80% think they're in the top 50%. This is statistical fact. Right? It's always the other person. So it's that emotive behavior. That's number one. Number two, how many have ever been to a casino and won on the first pull or first bet? What do you do? Or you gone to the horse track? What do you normally do? Go again. Go again. Bet more. Right? You're like, okay, this is easy. Can we up the minimum bet? Studies have shown if you invest and you win right away, your aggressiveness goes up even more. So again, another behavior that goes against us. But what happens is increase in risk when market rises. So you're putting in more money. Like, oh, this is easy. I'm just going to keep piling more money in. But we know that people reduce their risk. They take money off when the market drops. This is getting too scary. I can't handle that. It's that emotional roller coaster. Right? So let's look at the impact from a dollars and cents perspective of human behavior. This is a study done over a number of years, from 12 months to 30 years, by a company called Real Investment Advice. And they looked at the individual investor, they looked at the fund, and they looked at the lag. And what they saw was that there's about a 4 to 5% right across the spectrum annual loss of return. And that didn't make sense, but they're all investing in the same thing. How do investors underperform, or why is that? There's another study done, and Globe and Mail looked at it, and it was by Vanguard. Vanguard is one of the largest index funds in the world, and they looked at the Vanguard Value Fund for 10 years, and they said, how did we do as a fund? Annualized, Vanguard did 5.8%, reasonable rate of return. How did their investors in that fund, same fund do, in an index fund, passive investments? 1.8. That 4% difference that we just talked about is attributable to human behavior. So they said, okay, well, wait a minute. Is that just in that fund? They started looking at some of their other funds. The growth stock fund, the small cap fund, the small cap growth. In all cases, investors underperformed the fund itself. And that was only attributable to human behavior. So how do we stop ourselves from being our own worst enemies? Right? You got to manage the asset more efficiently. This is an example of our portfolio in 2015. Part of it went up 11.4%. Part of it went down 7.5%. But what we did was, by rebalancing over time on a quarterly basis, at least, we're reviewing your portfolio, rebalancing, taking the cash flow and the profits from here, buying them cheaper in these assets that are going down here. And so the 2015 blended rate of return was actually positive 7.48. Because as some assets are increasing in value and producing that cash flow, we take that money and we reinvest it where it makes sense. Because the asset allocation is still sound. It just might be that asset class is pulling back a bit. A specific example I want to talk about in 2015 is the preferred share market. Some of you might have been aware that at that point, preferred shares were down 35%. Yields were up more than 50%. And rate resets and bank preferreds were the reason. That was the cause back then. So the taxes, remember, on preferreds are very favorable, about 20% less than interest. So a preferred that was maybe yielding 6% is the equivalent of getting a bond paying you 8%, but it's more tax efficient. And so there was a good chance, we felt, of that recovery. I mean, these are bank preferreds. Where are the 5 banks going? So when you look at it, and this is our preferred fund back then. Our preferred fund, hard to see, but it did 5.3% before fees during that whole period of time. Also, what you might see here is that during that year where we bounced off the bottom, there was a 35% year recovery. So what did we do, and what did clients do? They started buying, as we were distributing cash. Remember, these are cash-producing assets. They started buying more units as the price came down, and dollar cost averaging. So this client, as he was buying more and more of these assets, actually his rate of return wasn't 5.3. His rate of return was closer to 7.9. All we were doing was taking the winners, putting it into the ones that weren't doing as well, and over time, that cash flow, or dollar cost averaging, catches up and produces super returns, if you will. We've removed the emotion by having that dollar cost averaging in. Emotion is where it gets us. It's the Vulcan. Now, we can't all be Vulcans, so we know that emotion, stocks and bonds together, those situations, and choosing the right combination of having unemotive investing. And when I say unemotive, it's discipline, and sticking that discipline is really important. And of course, going beyond the traditional stock and bond model, that's what's going to change things for you. So before we sum it all up, good investor behavior is very difficult to manage. 90% of the investors don't earn the benchmarks, and that's simply because of who we are as individuals. Volatility can lead to that bad behavior, so if we put processes in place, we're going to overcome that. Diversification is safe, but not if you're just in stocks and bonds. You got to go beyond that, and we've seen that in the last little while, that all of a sudden the bond markets and the stock markets are doing things that haven't seen historically, which is moving in tandem. The correlation, and it's so quick with all the index funds out there, with all the automated trading that's in there, as individuals, it's hard for us to get out of that cycle. So what we do is we put in a disciplined process. Picking quality assets does take time and patience. We at Nicola Wealth Management, if we don't have the in-house expertise, we go out and get it. We're not so hung up on ego that we've got to manage that asset class. We'll partner up like we did on the real estate initially. We'll partner up on global real estate with Invesco Trimark if it makes sense. So all of this really comes down to the workbook and starts with the planning process. So before we get into the workbook, we're just going to have a short break for questions and answers. I don't know if we have any questions that have come in. If we have any questions from the audience, happy to take it at this time. Thank you. Yes?
So you spoke about the workbook.
Yes.
What if you're already retired? Would you just plug in at the retirement age and let us know how much we could earn without taking away from the principal, or is that
Yep.
how it would work?
And we can go through that. We're going to do a live workbook example. So if we want to model that for you right now, we can do that. But what we do is really customize it to the individual, because let's assume you've got a professional corporation. I'm just going to use that as an example. I don't know if you do or do not. And you have real estate holdings. Those are cash flows. And we're going to look at how best to maximize your after-tax cash flow. So if you just have a RIF and that's all you've got, that's pretty simple. But if you've got a RIF, you've got pension income, maybe you've got professional corp or a holding company, you've got real estate, that income that you need, you can derive it in many different sources. And you're also going to have an investment portfolio. So what we'll work with individuals on is, you tell us what your lifestyle needs are. That's one question. Some people say, look, I have no desire to leave anything to anyone, right? I have worked hard to put, save my money. I help with the kids as much as I'm going to help. I've given to charity. I've done what I want to do. It's about what I want to spend. And so, if you say to me, look, what I want is what we'll call good tax planning, which is when the last check to Revenue Canada bounces. That's good tax planning. So if you want to spend every dollar, then we'll tell you, look, you tell me what age you think you're going to live till. Let's say it's 95.
I can give you the date.
You give me the date. And we'll model that out, right? We'll also model in what-if scenarios. Right? What if I live to 97 instead of 95? Right? What if market returns aren't as good, so I want to be conservative? Our job really is to be conservative. Our job is to ensure that if we're missing the mark on your planning, it's because we've been a little too conservative, because I don't want to leave you at the end with no money. I'd rather leave you in with a little bit more money.
In case you live.
In case you live, right.
Yeah. I'm assuming you have a minimum amount of money that you're willing to deal with.
Right. The minimum is $1 million as a family. Okay. So you might have 300 in your RSP, 700 in your corp. You're at that million. And we find that that's a number that makes sense for a lot of people for the work that we do. And from a planning perspective, it's really important. One thing that I will say about Nicola, and again, I'm relatively new to the company, though I've been in the industry a while. I want you to go on any wealth management firm's website. You will not see what their returns are net of fees. I'd be shocked if you saw what their returns are net of all fees. You'll see that on Nicola's website. Many wealth management firms don't even actually tell you what their fees are. You'll see that on Nicola's wealth management. My philosophy is, like, if you've got something that's pretty good, like, why wouldn't you tell everybody about it? Why would you keep it secret? And so what we've seen here, this is actually our model since 2000. And our annualized net rate of return, net of all fees and costs, have been 7%. What I want to point out, though, is look what happened here in 2008. Many of us remember that. And we outperformed every asset class and every one of these things, whether it was a typical balanced fund, whether it was the S&P 500 in Canadian dollar terms. And that was really as a result of the cash flow investing. If you think about owning, a commercial real estate, it's a great example. You've got a couple floors, you're renting it out. If the value is $10 million today and you're collecting, $100,000 in cash, I'm just using as an example, that's your rent and you're living off that. And all of a sudden the value of the building falls to $9 million. Do you care? If that $100,000 is still coming in, who cares? And so if we can get you a cash flow of, I think in 2008 we were at over 4.8% cash flow. So that meant if you needed around a 5% cash flow to live, remember that number's 2 to 5 that we showed you? If you needed a 5% cash flow, you weren't selling your portfolio when the market was down, which is why you're able to recover. And so that's one of the things that's really unique about this. This is actually the core portfolio, which was started in 2013 to allow clients who had smaller amounts. If your TFSA only had 20,000 in it, you can't go out and buy all these things. This is essentially our core model, which replicates everything you've seen since 1994. And you can see that last year, this is as of December 31, we had a cash flow distribution of about 4.8%. So even though the return was 2.6, right, because we were able to generate 4.8% cash flow, we did not have a negative year last year. A lot of other firms did, a lot of indices did. If you have cash flow, you're okay. Our since inception number, or 5-year numbers, traditionally have been strong. It's that real estate component, it's that private debt, it's that private equity, because typically, you can't, as a retail investor, get into those things. They are reserved for the higher net worth, the pensions. What we've done is taken everybody's money, pooled it together, gone out and partnered up with people on the private equity, the private debt. We own first mortgages, we own secondary mortgages, and we get that cash flow coming into you. Thank you for your question. Any other questions? Yes, in the back.
One over here on Facebook Live, so got some people engaging, which is great. We had someone ask if these investments qualify as RRSP investments.
So that's a great question. So we've actually recently made some changes that we are now able, so as you can see here, again, your right, we have a list of all of our proprietary funds and limited partnerships. We have made some, for tax purposes, the limited partnerships are set up so those funds are not available for registered assets. So this would be in real estate, private equity. We have a new infrastructure fund that we recently launched as well. Good news though, because a lot of people do come to us for our real estate, is that we just started a new managed real estate fund that holds all of our real estate limited partnerships, which is RSP eligible. So short answer, not all, but now we're a little bit closer to having all of those available in registered accounts.
Thank you. Any other questions before we dive into the workbook? Yes, follow-up question.
I just heard you say something about quarterly rebalancing.
Yes.
Is that on a personal basis? That would be somebody from you. Now, I'm sure there'd be some kind of computer-generated output that you would review, but how would you review that? Would you review it with me, or would it be just something you made recommendations?
I'm going to answer.
Yeah, sure. Please do. Go ahead.
So we review all of our clients' portfolios on a minimum of 90 days, and it's not a computer. So I would be taking a look, and really with our process, what we would do is we would work with you, getting to know your personal situation. So this is really where it's a different experience. So we really do want to get to know you, what your objectives are, what your income requirements are, when you need access to your capital, and what that may look like. So we're not just going to stick you in some fund. We really want to make sure that what we're recommending is appropriate to your situation.
Whoops. Somebody's calling me. That's not my kid.
We'll just ignore that.
Don't tell my wife.
Yeah. From there, what we're going to take a look at is really create your own custom asset allocation. So for example, on your left, you can see that we have an allocation across all of our different areas. So foreign equities, Canadian equities, private equity, real estate, as such. So we are going to try to come up with something that, again, is suitable to your situation, and from there, further allocate you into the individual funds. What will happen is over time, as Ron explained, we'll have some winners and we'll have some maybe turtles. It's a little slower to get going, and we are going to rebalance to those agreed upon targets. And that's in 90 days, or as cash flows come in or funds are required, and we're going to do that over time. Now, with our process as well, if we do, as a company, see a strategic shift where we do want to make a larger change, so we're not just talking about kind of rebalancing up to those agreed upon levels, we're going to make sure we have a conversation with you. So generally those 90-day portfolio reviews are done internally by us, and we are discretionary portfolio managers, so we are licensed to act accordingly. But we do review this with you as part of the semi-annual and definitely annual reviews.
And as Jessica was saying, we have a fiduciary obligation to act in your best interest, put your interests first. It's just like patients, it's just like doctors and dentists. You've got to put the patient first, right? That's the same fiduciary obligation we have. The other thing that we sometimes get asked is, and I'll just let you know, is the money isn't at Nicola Wealth Management Bank, right? It's actually held at National Bank, and it's in your name. So the money cannot go out of your account to somebody else's account. It can only go from your Nicola Wealth Management account to your bank account. Those are the only two places it can go. So if you say, oh, well, you know, I'm buying a boat for $50,000, can you just send it down to Florida? The answer is no. I can send it to your bank account, and you can send it down to Florida. So it's important that you know that that money is held outside of the Nicola system. What you do is, as your discretion manager, is give us the authority to act on that money in terms of managing it and moving it around. Yes, question up here.
You'd mentioned about Nicola Wealth having a fiduciary responsibility. Can you explain the difference about fiduciary responsibility versus other brokerages that don't have that same standard?
You want to take that, or should I?
You can go ahead.
So this is a term that our industry is grappling with, and it's about putting the best interest of the client first. I have been in the industry since '93, so about 25 years now. I started when I was 12. Let's just be clear about that. And I started as a stockbroker. I don't know if any of you have seen, you know, Wolf of Wall Street kind of movie. I was dialing for dollars. That's what I was doing. And the idea was, you know, call the individual, get the commission, book it. You can't do that as a fiduciary. You've got to put the client's best interest. So in a situation where you have a choice to make, where it's the client's interest versus, but I'm going to make less money on this, there is no choice here. There's only one thing and one thing only, and you've got to put the client interest first. We are held to the highest standards under the Ontario Securities Commission. We are licensed. We have to be as investment counselors, and we have to pass. It's not enough to just say, hey, here's my application, here's my license. They do credit background check, criminal background check. You know, they're not just looking at you, they're looking at to see whether you have ever been part of a company that has lost money or been defrauded or anything like that. They do a real extensive criminal check and background check. So it is really about putting client first, and that's a legal obligation that they've got to do that.
And I'll also add, in terms of our compensation structure, again, your portfolio is charged an asset management fee. We don't receive any bonuses. So as Justine mentioned, I used to work at MD Management, so I'm very familiar with how staff there are paid, and their bonuses are driven. I also worked at one of the major 5 banks, and it was very eye-opening seeing, again, the types of bonusing is based on the products they're selling and how many boxes they can check off. And that is not how we operate, and it's not how people should be operating or how you should be receiving advice.
Our interests are perfectly aligned with yours as clients, right? If we're growing your portfolio conservatively, then because we're on a percentage basis, we're going to grow our fee. If we're doing things wrong, it's not working out. That's not a good thing for you, certainly, and certainly as us in terms of compensation. So we want to continue to grow that, not for 1 or 2 years, but for a lifetime. And that's why you have 2 planners on every file. We want to be with you for the rest of your life, is a continuity piece. And so as our firm has grown, you know, in 1994, John didn't have 180 staff. What we've done is been able to continue that continuity. So, you know, you might start off for the next 5 years working with Jessica and I, but in 6 years from now, you know, one of us might move on to a different client, but one of us will always be there, and you'll bring in somebody else to that continuity. Because you don't want to have to tell your story again. That's very frustrating, or have to get to know people. So that's one of the differences at Nicola, is you do have a team working for you, and we plan to be around for a while. Question in the back, yes?
Sorry, it was just more of a comment again from Facebook. Just if you guys could repeat the questions that people are asking, because we're not mic'd over here, so they can't hear it on that end. So
Great. I'll repeat the question. I know we had a question up front. Yes?
Oh, you had mentioned about integrated approach.
Yes.
Does that mean managing the entire family wealth, or do you separate portions of it between, say, spouses or?
So the question for the Facebook audience is, when we talk about integrated wealth, are we portioning it out, the money, between spouses, or are we managing it as a family? And the answer there is, it depends on the family. We have families, we work with about 1,200 families across Canada. We have some families that are very together, and they you know, multi-generational across families. They might own a business. So a lot of the compensation discussion, we have a lot of entrepreneurs who own private shares in their company. So the advice we might give to mom and dad might be different than the advice we give to the kids, because of the different situations they may find themselves. But we also have clients, husbands and wives, spouses together, who manage their money separately. And so You need to tell us what's important to you, and then we will manage it accordingly.
Yeah.
Right?
But for the planning piece itself, it is very helpful even if a spouse's assets, aren't with us. We still want to include that information because, again, you're planning together as a family, presumably in terms of your long-term goals and objectives. So having the overall picture is really what's important to us. Whether 100% of those assets are with us, that is not as important. It's really making sure that we understand the picture. Because if we only have half of it, again, we're not doing our jobs in terms of being able to illustrate, what things look like in the long run.
Great. Yes?
I just have a question. So we're coming off 2018 very strong, right? 2019, interest rates are supposed to go up at some point. Maybe we push it to 2020. Maybe instead of saying recession 2020. So what is your response time to adjusting to a shift in a change, an overnight change in the market? NAFTA could have done a lot of damage if the auto sector would have been affected. So that would really affect everybody's portfolio depending on what you're having. So how do you, what's your plan, procedure, protocol for something like that?
So the question thank you very much for that question. The question for the Facebook audience is how do we adjust to quick market moves and quick economic situations? Maybe, for example, a few days ago, or was it last night, we saw in the middle of the night, Brexit was voted down, the exit plan. How do you adjust for that? We don't. And the reason I say that is that's an emotive reaction. By the time I've read about it and our management has read about it, it's been factored into the equity market or the stock market. If we're doing our job right, we're forecasting. And we're looking at, given the certain expectations in the market or in the economic marketplace, not the stock market, the economic marketplace, we think these are the sectors to be in. So we may overweight or underweight certain sectors. If we've made a call that we think is correct and it starts to go south, we'll just put our discipline in. We'll start buying it a little bit cheaper. We don't expect to be taken completely offside. If the market's gone down, everyone's gone down. But if we adhere to our philosophy, which is cash flow investing, it means we'll be able to buy these assets, again, on a dollar cost averaging basis, much cheaper. So we try and avoid the emotive reaction to get out, or the opposite. Markets take off. We're not going to chase those things. We continue to be disciplined in our approach and say, does it make sense? Great questions. Yes, question over here.
What percentage of your assets are in Canada as opposed to world assets, or like where do you diversify across the globe?
So I believe so we have about 30% in the U.S. Oh, sorry. The question is where are our assets held, I guess. So I would say we have about 30% with U.S. exposure. So whether that's in physical hard asset real estate, the stock market, global bonds, and high yield bonds. We do have a fairly large percentage in Canada, so obviously the Canadian stock market. Our mortgage pools are all based in Canada, in addition to a fairly significant portion of the real estate. So we do have a very diversified approach. Yes, but generally North American. We're also now in the global real estate market. So again, that's a new shift for us, is looking to other places than North America for real estate opportunities.
Do you hedge your currency exposures? Like, for instance, U.S. dollars vis-a-vis the Canadian dollar?
No.
No, we don't.
No, so the question for Facebook was, do we hedge our currency? The answer is no, because the cost to hedge, studies have shown, don't bear out the fruit. You're better off just allowing it to ride out. What we will tell you is that we're not looking at it on a 1 month basis, a 1 year basis. We're looking at it over the lifetime of your assets with us. What's going to happen to those assets? Yes, sometimes going to be some volatility, even in the currency market, but all studies that we've seen say hedging is inexpensive, and even the best hedgers don't get it right. So we don't spend the money there.
Yeah. And we do have funds that are available for investment in U.S. currency, which our clients do appreciate, because if they are traveling down south to the Caribbean, we can actually generate that U.S. cash flow and just send that out. So they're not necessarily worrying about converting at the time of their travels. We can just send that to the U.S. dollar bank account.
These are some great questions. I have one in the back there.
Sorry, hi, thanks. You emphasised that real estate was a big part of the portfolio, the difference in stock and bonds. Can you just tell me a little private equity and the alternative strategy components?
Sure. So the question is, other than real estate, so kind of an explanation in terms of our alternative strategies and private equity. So with private equity, we do a combination of direct investments. So Nicola Wealth is going with our portfolio managers and is finding opportunities in private business. So that'd be a direct investment. We also have co-invest, so we are going in with another investor for that same opportunity. And then finally, we do work with a number of private equity funds across North America, again in different markets, for investments in their funds. So even within private equity, we are very diversified in terms of the types of businesses and locations and the size.
I'll also add that if you want any information on any of those pools, again, it's 100% on the website, the public site, everything's there. The performance is there, net of all fees. We believe in transparency. It's really important to us to let you know what we're putting you into. And part of the reason is that's where our money is. That's where John's money is. That's where Jessica's money is. That's where my money is. It's right alongside yours. So this is not about, hey, we're going to buy, for example, TD Bank for you, but I'm buying Royal Bank in my stock, my portfolio, right? We're putting our dollars right alongside yours. And so this would be all our different funds. And if you clicked on any one of them, you would see the same thing you saw with that core fund, which was the performance, the asset allocation, the net of all fees, everything's in there for you.
So also we recently have launched an infrastructure and renewable resources fund. So this again is a non-market, market neutral fund. So it will react and act differently over time than the market, which again is really key for us. We had started off with actually investing in farmland, so Canadian farmland. So we were going out with a partner and buying farms from farmers and renting it out. So generating that cash flow and having obviously long-term capital appreciation. The good and bad about global warming is that Canadian farming is actually doing quite well because we have a longer growing season and more physical land to farm on. What we were finding though is we weren't actually able to get that scale that we wanted to for our clients. So we had people lining up wanting to have this opportunity, but we couldn't find enough farmland. So what our team recently did, and we launched this at the end of September, is we expanded this to include other renewable resources like timberland. We're looking into infrastructure projects, so building roads and highways and dams and things again that, regardless of a recession, are still going to get built. So again, it's a great opportunity that we are providing and continuing to add value to our clients where again, it might be cost prohibitive to go and buy a highway or build one yourself.
There's a question from Facebook.
There is another question, yeah.
That's
if
great.
you hold 100% of your investment in foreign currency, like USD.
Yes. Sorry.
So the question is, can you hold 100% of your portfolio in US currency? So yes, we are able to do that. There's some, I guess we'd want to talk to the client about like why they would want to do that. Right. Again, really learning about the specifics around this. Again, we are not trying to win on exchange. That is not our approach. The head of our portfolio management team has an interesting story about how he had, in his previous life at a bank, his team had been given kind of a fund to try to win on currency. After a year, they pretty much all lost. So we are not trying to gamble with currency.
So we want to be mindful and respectful of everyone's time. I don't want to stop the discussion. We're going to happy to take more questions after the next phase, which is the workbook. And we'll also be around as we're milling about afterwards to have some discussions. But perhaps maybe we'll get into the workbook.
Sure. So we wanted to review this with, just to give everyone a kind of a flavor in terms of that client experience. So we've put in some information, but we definitely want to make this interactive. So I'll just kind of go through the examples, and if you want to shout out different numbers, by all means, please do so. So in this case, we have Mr. and Mrs. Client. We have some joint holdings. We have a holdco and an opco. We've put in some traditional accounts that most clients will have, so some level of registered savings plan for retirement, some tax-free savings account. In this case, the clients have some kids, so they have an RESP. So for this client, we've kind of assumed registered assets about 1.2 million. Does anyone have any changes they want to make? Sounds good? So again, what we would then go down with these clients, again, they're saving in their holding company. So they've acquired about $750,000 in Canadian currency and about $250,000 in a US account. And for the purpose of this, we have actually converted the US account to Canadian dollars because, again, it's all for the planning. We've included, they have a primary residence and a vacation property. At this time, they have not purchased any commercial real estate, but maybe that's something that's on the horizon. Of course, with our clients, we have some permanent life insurance in place. And again, with that cash value, we're really looking at the cash value for the purpose of the net worth statement, not necessarily the long-term death benefit. If these clients had any return of premium on their critical illness or disability policies, we'd also want to factor that in. And great news with these clients, no liabilities. So again, with these clients we'd work through, and usually with this, and I know there's some accountants that we work with in the room that can attest to this, is that we definitely do like reviewing compensation structures. We know that, I'm sure a lot of you know, with last year's or 2 years ago's changes, compensation and salary and dividends, it was, things changed with the change of government. So it's something that we do want to continue to look at, again, depending on our clients' income requirements and also their revenue. So we would go through this just to illustrate what we can project for their cash flow. Okay, I'll make this a bit bigger. So we have this client who's 45 and their retirement objective is age 60. Again, we've shown that they're going to enjoy retirement until age 95. And again, this is something that, as our clients get older, we reevaluate that age. I have some clients that are approaching 90 and we keep on pushing that time frame back. It's a very, trying to make a fun conversation about that life expectancy. Again, in terms of projected rates of return, again, we're showing about a 4%, but we do track our clients' performance, so it is something that we're very cognizant. Once we have that history of their performance with us, we are going to keep an eye on it over time. And ideally, we do want to generate a larger rate of return, but for planning purposes, we do want to be more conservative. So what we take a look at with clients is, in this case, again, we have about current savings, so that investable asset is about $2.2 million. And these clients have initially identified that they'd like to spend, really enjoy retirement and have about $240,000 a year to enjoy for that period of time. You can see we have factored in that they are planning on selling their practice at, say, age 60 for about $1 million. We have included inflation on this number. And there might be some other sources of income like CPP and maybe OAS. So in this initial client scenario, they would need to save about $100,000 a year for the next 15 years in order to generate that retirement income. At the end of the day, their investment assets would actually double to about $5 million in today's dollars. However, that number on the statement, because we know with inflation, is going to be close to about $13 million. And again, this would exclude the value of any real estate that they own, as we have not factored that in, or the value of their insurance. So again, this is trying to be interactive. Does anyone want to see any other changes to this? So maybe retiring earlier or enjoying more? Is this? Yes?
What about if you think you're going to need so much money per year until you're a certain age and then less after that? Or,
yeah.
If I'm finding that he has a stroke and dies. I just different things.
That's a, so the question is, how can we kind of account for changes of cash flow during time?
That would be a better
Yes.
way.
Okay. So one way, for instance, let's say that between age 90 and 95, you need less because maybe you're not going down to Florida as often or whatever it may be. What we can actually just show is that we kind of include an income source, which may not be there, but it's essentially saying, okay, we're going to have this income coming in. Between that period of time, let's put some inflation. So you can see that what it will actually do is it will reduce the savings component Again, if you know that through this period of time you're saving $100,000 a year, and that's your objective, we can then just say, all right, well maybe there's going to be a bit more left over at the end of the day. And then we can also do the opposite. So if you do need more for extended periods of time, we would just reverse it. And ideally, a lot of people may want to end with $1 in their pocket. We essentially don't want to see what we call a shark fin here. So we don't want this diving all the way down. We want to make sure, obviously, there's a bit of buffer because we know that life will change. In this case, we're obviously looking at a 45 or 50-year period of time. And that's why, again, we want to review this with you every year because we know your objectives will change over time, and that's okay. We just want to be able to illustrate and help and be your partner in terms of making decisions on the financial side of things. Any other scenarios that, or questions about kind of a bit of this process?
Maybe, so if we're done with this, I'll just wrap up just with one last thing that many people aren't talking about yet, and I want you to start thinking about it. And that is estate planning. And I don't mean the estate planning on the insurance side. That's an important part of it. I'm talking about the what if I'm not well scenario. Someone's had a stroke. So it is important that in the province of Ontario, you, under the Substitute Decisions Act, have your papers in order. There are certain things that you can put in there. I could tell you that in my own personal situation, I put in there DNR, do not resuscitate, no heroic measures, if I'm brain dead. Right? I mean, those are things that I specifically put in there. You can also be more prescriptive if you want. For example, on my personal care, I put in there that if I have no idea where I am, i.e. I've got dementia or Alzheimer's, I want to be not at home. Because in my mind, I've got 4 kids, and I got my wife. I don't need my kids coming home every day and seeing dad, in his state of mind. I'd rather be in a home if we can afford it, and so forth. So again, you can be as open or prescriptive as possible. In our situation, I put the power of personal care in my wife's hands, and I put the power of attorney for our finances, or my finances, in her dad's hands. That's not because that's, I'm taking it out of her hands. When we designed these POAs, it was, she's got 4 kids to raise, right? Her dad is a business person. He understands that he's going to look after what she needs, and that's not an issue. That was a decision we made together. And then finally, the executor appointment. If something were to happen, who's going to be an executor? If you've got kids, obviously who's going to be the guardian and the trustee of the assets for those kids? These are important things. One area of estate planning that is brand new to all of us that didn't exist 20 years ago is estate planning on digital assets that many people forget about. So if you're of my age, you've got photo albums, right? You pull them out and you say, okay, well, mom died, so we all get to choose the different photos. What do you do with all those millions of pictures you have in the cloud right now? Who's got the passwords? How are you going to get, so if you're like me and you get all your bills online, and if your wife doesn't know the access to your password, she does. My wife does know. But if she didn't, who's going to get that? Right? And it's no different if you're running a practice. If you're the person getting all the emails and you're the only one with access to that, how's your staff going to get to that? And so these are things I want you to start thinking about in estate planning. Finally is the transfer of wealth. And there's what's equal versus what's fair. And these are all personal decisions. I can tell you, my family, I've got 4 kids. My parents have 4 kids. I'm the third of 4. I'm not going to get an equal distribution. I'm not getting 25% of the estate. I have a sister who needs it more. My parents said, that's what's fair. That's my parents' money and that's their decision. But again, these are discussions that you should be having with each other, with your children, with your advisors, including yourselves. And as a TEP, a trust and estate practitioner, that's really important. Because if we know that, part of what we can do in the planning process is make sure that there's an equitable or fair distribution of your assets should something happen. Somebody might get the RSP, somebody might get the house. Well, the tax liability on the RSP might eat into the house. So how do you deal with that? So these are discussions that we want you to have with each other and certainly involve us as planners. It's really important. So if there are no any last questions for us at all, we have one from Facebook.
Text message.
Text message.
In the room. So can you comment on your investment philosophy versus investing in ETFs?
You want to take that or should I?
Sure.
Okay. So the question is, our investment philosophy, investing in ETFs versus our investment philosophy. ETFs, or index funds, I showed a whole big slide about how they've done. You're going to follow the market. Are you unemotive enough? Are you putting the planning in place? Are you dollar cost averaging? Do you have a regular plan? We do believe that you can add value beyond the index, and you should be, or you shouldn't be being paid as a manager. So how do we do that? Through cash flow investing, through looking for those sectors and those asset classes and those stocks within those asset classes in the index, and saying that's the one I want because it's going to produce me some cash flow, so that when that volatile period hits, whether it's a banking stock, whether it's a healthcare, no worries, I'm getting cash flow. And because our investment philosophy goes beyond traditional stocks and bonds, index investing doesn't get you into commercial real estate. It doesn't get you into private equity. You can't do that. So if you ask yourself, what are the high net worth individuals doing around the world? What are pensions doing around the world? What's CPP, Canada Pension Plan? We're all owners of that. What are they doing on your behalf? They're doing the same thing we're doing for our clients. So we don't believe in passive investments. We believe in active management. With that, I want to thank you all for your patience. Our big thanks to Zavitz out here and the whole group. Doug and everybody for feeding us tonight. Thank you so much to the whole Zavitz family.